Good afternoon and welcome back. I am Craig Sullivan, your host, and now it is our overview of the California hotel market. This is going to be our last panel of the day, and we have got Ms. Jackie Collins of Gallagher moderating this all-star panel. So, Jackie, it's all yours. Thank you.
Hello, everyone. As Craig said, I'm Jackie Collins. I'm with Arthur J. Gallagher. Excited to do CLIC 5. We've got a great panel for you, and this is the overview of the hotel market. And I'm going to let Mark LeBlanc start by introducing himself, and then we'll just go around the panel.
Great. Mark LeBlanc with Aimbridge Hospitality.
Mark Crisci.
Here we go. Hi, everybody. Mark Crisci with Azul Hospitality Group.
Ronald.
Hi, Ron Kim with Prospera Hotels.
Lynette. All right, still no volume. Okay, Jeanne.
Hi, everybody. Good afternoon. I'm Jeanne Muscolino with JCJ Architecture.
Alan.
Good afternoon, everyone. I'm Alan Reay, Atlas Hospitality Group.
And Suzanne.
Hi, everyone. I'm Suzanne Mellen with HVS.
All right. So, Lynette, I will come back to you, and then we also have Robert Lowe that should be joining us. Let's just start this off with what are some of the issues presented by COVID, and how has the industry responded to these issues? Ron, you want to start off with answering that, and anyone that wants to hop in, feel free to do so.
Sure. Obviously, the impact of COVID was a big hit to our occupancy in our portfolio. We're primarily in the Disneyland Anaheim Resort area, so heavily reliant on our two major demand generators that are now completely shut down and have been, both the Disneyland Resort and the convention center itself. But it also really obviously impacted all of our employees. You try to keep them as long as possible. We had PPP loans that were available to us, but that only can last for so long. So it's been devastating to our market. Now it depends on where you are. Like it seems like this sort of pandemic has seen a sort of a K recovery where certain markets have done really well, like the leisure markets and sort of the beach located markets. But convention, group, corporate travel markets have really devastated the hotels.
Very good.
Very bad.
As a result of, go ahead.
No, I was just gonna say it wasn't very good. It's very bad.
Yeah, right. Jeanne, so from a design standpoint, what are some things that you guys are seeing different now because of COVID? And share with us a little bit about that, if you will.
Sure. So we're seeing a lot of interesting things happening, both in California and across the country. One of those things, with the risk of sounding cliche right out of the gate, is an emphasis on authenticity and really locally inspired design. I think one of the things that's driving this is one of the silver linings of COVID, really, and that's that sort of newfound appreciation for what's local in the market, right, for where we are and who we are. I found that people have been really forced to trade in their dreams of exotic vacations, for something more drivable. And it's great to see people discovering or perhaps rediscovering some of the hidden gems within their own backyards and within their regions. So some folks, for example, might trade in their trip to Cabo or Greece, and they might go to Napa or Palm Springs instead. So those properties are really working to respond to that. They're working to introduce local materials, cultural aspects, custom design that's really going to help capture the character of their place within their space.
Sure. Alan, regarding buying and selling, how has COVID impacted transactions? And in particular, what happened with the Project Home Key?
Yeah, so in sales in California, most other states were down anywhere from 40 to 70% last year in terms of number of hotel sales transactions. California bucked the trend. We actually went up in sales transactions, which I think surprised everyone. And the main reason for that was the Project Home Key that was announced by Governor Newsom in June, and the state, and with the use of federal grants, closed just under $1 billion worth of hotels in California. All of those transactions closing in the last 6 weeks of 2020. So even with the COVID transactions, even though sales were up, dollar volume was down, but it has had a huge impact, not only on 2020 California sales, but it will have a huge impact on the first quarter sales as those hotel owners are now completing 1031 exchanges. So it's been major impact.
Are you able to talk about how that compares to the rest of the country?
Well, the rest of the country, as far as I'm aware, did not have anything like what we had in California in terms of funding or how quickly these deals moved. Again, it's usually very difficult, if not impossible, to purchase a hotel and have it converted to apartments. But because it was done through the state and the federal level, we've never seen anything like that in California. So one of the upsides there is that, as we all know, if you increase hotel development and increase the supply of rooms, that has typically a negative impact on value. Again, last year, California actually lost room supply, which is the first time that that's ever happened in the last 20 years of us tracking it. And I don't.
What did that do to the value?
I think it's going to put, ultimately, when we come out of COVID, it's going to put pressure on values, and especially on hotels that are in the budget segment, where the vast majority of the home key transactions were in. They did buy a few residence inns, but most of them were in the budget segment, which also already was hit by development costs. So no one can afford to build a budget motel, and they've also taken out a lot of that supply. So I think it'll create values in the budget segment, especially, to really jump.
It's the thing that I found interesting over the year in talking to various hotel companies is how the extended stay market has fared throughout all of this in comparison to other classes of hotels. I've just found that very interesting. Mark LeBlanc, where do you think the best place to buy is right now? Where's the best opportunities?
You know, I think it depends what your exit strategy is first, because if you're still looking at a 3 to 5 year hold, I don't know where those deals are, frankly. It's going to be hard to find if you want to take deep discount. But where we are seeing some values is in secondary and tertiary markets. Just kind of anecdotally, TREP report came out, and in the top 25 MSA markets, Portland, it was Portland, New York, and I forgot the third market that were the worst. But that was in the top 25 MSA. If you get into the secondary markets, the tertiary markets like Eau Claire, Wisconsin, they have 100% delinquency on their loans in those markets that are CMBS loans. So I think if you're willing to go in those markets, you're going to find some discounts there. I think if you look even at a Portland, I think if you can find a property you liked, in 2019 and now it's 20% discount, you should take it. But I don't think they're going to see 40% discounts in too many markets. Now, as time goes on, and maybe Ellen can speak to it, your big urban markets or airport locations, airports like LAX, they're not going to bounce back for a long time because it's the international travel that really impacts there. And I don't think the best case scenario is going to be a year to 18 months. So you're going to have to feed those big boxes for a long time. You take downtown Los Angeles, this isn't a slam in downtown LA, but it's not like New York. People don't go downtown LA unless there's something going on in Staples Center or or, a convention in town, they don't usually use that for their basis to do sightseeing. So when's downtown LA come back? Not till the conventions come back, and that's probably 18 months to 2 years, optimistically. So,
Alan, you have any comments? You have anything to add to that, Alan?
Sorry, I had my mic on mute. No, I agree with Mark. I think it's interesting that Sunstone sold the Renaissance Hotel at LAX, and it went at what I would consider an aggressive cap based on what the forecasts are for the LAX market. So I think, we've heard it time and again, the downtown markets that rely heavily on international tourism or on convention center business, it's going to take a long time for them to come back. The deals that we're seeing in the coastal cities of California and the Central Coast and La Jolla, and even over in Catalina, some of those properties, if you look at President's Day weekend, a lot of clients that we were talking to in those markets achieved higher rates and occupancy than they'd ever achieved for that weekend. So huge pent-up demand to drive-to markets, but I agree with Mark. I think it's a long road back for business center hotels, convention center business, and obviously we still have escalating costs, especially through labor. And again, I think this bodes well for smaller, independent, local hotels.
Right. Yeah, and guys, I know this is different than we're accustomed to. We're in person. So if you have anything that you want to comment on, just raise your hand or something and let me know so I can call on you, okay? Lynette, are you able to speak now? You there?
Yeah, I can hear you.
No, Lynette.
How about now?
Yes, perfect.
There we go.
Good to hear your voice.
I knew there was a magic button.
So, Lynette, what kind of role does diversity play out in California and the hotel investment side? And how does it, and in the industry as a whole? Can you speak to that?
Sure. Well, first of all, since I didn't get to introduce myself, Lynette Montoya, and I'm the president and CEO of the Latino Hotel Association. And our primary goal is to promote hotel ownership amongst Latinos throughout the U.S. It's truly been a crazy year because we had so many great plans as we were retreating in October 2019 for 2020 and 2021. And what we imagined was just a huge outreach to Latinos, and especially in California. We have California, it has 39.4% Hispanics, which nationally there's 18.4 Hispanics in the US. So that's a huge number. And I know you all who live in California know what I'm talking about. There are about 13.3% of Hispanics that are actually working in the hospitality industry. The percentage of hotel owners, and it's people like Alan and Craig that I can speak to about identifying those owners, and there's not very many. So we're negligible in percentage as far as hotel owners. So it's something that we really want to work towards. I work with an organization called the National Association of Hispanic Real Estate Professionals out of San Diego, and they have a accelerated way of really helping these real estate professionals by building their wealth. And part of their the Hispanic Wealth Project is to really create that wealth opportunity, and hotel ownership is definitely a play in that. I mean, right now it's really hard to sell that, but at the same time, we all know we're in this industry for that reason. We know it's the best industry there is, and there's a lot of opportunity. And if anybody needs a breakdown of origin of Hispanics in California, I have a lot of data. I work with a guy by the name of Mike LaCosta with Ethnifax, and he is just ready, willing, and able to provide data that could be helpful in any origin, but he works with us, and we're really fortunate to have him. And then, there's so many other things. There are 40% of California Hispanics that are 24 and under. So that Hispanic population is going to continue to grow. And then 51% of California Hispanics are between the ages of 25 and 64. And so this is, there's a lot of information out there, and we continue to gather it. And we continue to know that most of our hotel owners are some in Texas and Florida. So California is an area we really want to work with. And I think that knowing all of you, I know you all will help in the process, and I will definitely bring you all into the fold so you can help us to educate Latinos, Hispanics in the hotel industry.
Great, thank you for that. Suzanne, on to the development side of things. Bruce had talked about a lot being out in the pipeline, and what new projects are you seeing that are out there, and what have you actually, what are they and where are they? What are you seeing as far as new developments go?
Well, there are a lot of projects that have were scheduled to open this year, and either they've just delayed because they had to because of the lack of demand and just pushed back their opening. But now they're typically scheduled to open now and into the spring and summer. So we're going to start to see more of that supply come on. And of course, it's at a challenging time when other hotels are reopening or just reopened and demand isn't back to what it was. So that's going to be a bit of a challenge. But we are seeing, people want to get these things open, lenders want to get them open, and we're working on a number of projects where they've been proposed or under construction for a period of time. And now we're appraising them after COVID, where when we first worked on them, it was before COVID. And it's challenging because it's hard to tell someone, well, it's costing you whatever it might be, $400,000 a room to build something. And we felt before COVID, it was, it was going to be worth more than that when you opened up. And how do you say, well, now we think it might be worth less than what you're paying to construct the property? And that's a tough pill to swallow. And as you can imagine, there are a lot of conversations about that. But people want to get them up and open. And obviously, there's a lot of optimism now in the market. But some of these markets where hotels are opening up are challenged. Like if in CBD, for example, Oakland, there's some of the things that they thought were going to happen to rejuvenate the city are delayed or not happening. And there's new supply coming. And right now, the commercial demand and group demand isn't there. And so well, where is that market going? A tremendous amount of risk. So anyway, that's going to play out differently all across California. And LA, of course, is getting a tremendous amount of new supply. So I think even with the reduction, to your point, Alan, of some of the supply at the lower end, I think there's going to be some challenges higher up the tier. But we're still getting requests for, new projects. There's an eternal optimism in California. It is a beautiful state. Everyone has full confidence in our tourism. And most of the projects we're getting calls about are to drive away getaway places, because right now the ADRs in those markets are phenomenal. And I think there's risk there because some of these properties are getting rates that they could never have foreseen, even occupancy that they couldn't have foreseen prior to COVID. And we know at some point, maybe 3 to 5 years, all these people who are driving to destinations now are going to start getting on planes to go back to Cabo and Greece and international locations. And of course, how that's going to play out, that's so hard to say. If all of a sudden you had an average rate of, some hotels I'm hearing $750 average rate. Now they're running $900 average rate. And how do you factor in deflating of that bubble? Like, do you say, okay, we think you'll get back to a $750 ADR in a few years in inflated dollars or something? Or do you think that it might continue once the consumers get used to that? And of course, all these hotels, none of them are accommodating any group business. And even some of the most, premier drive-to hotels have usually accommodated some small amount of group business at a lower rate to fill up during those off seasons and midweek periods. So when that comes back, it's going to impact your rate. So I think it's just, if everybody's just aware of the phenomenon and they do an analysis of group and transient demand for these hotels and assume some kind of normalization in the future, we should be okay. But
What about,
go ahead.
sorry, what about from a construction cost? Is there additional expense associated with these changes that are being made after COVID, like, you know, taking in consideration social distancing, cleaning, etc.?
Well, for sure, I imagine that there must be some change orders that are going on. I mean, some of the projects that we've seen, but we've been hearing construction costs go up generally speaking, primarily on some of the core supply issues of the core components of the hotel, because
Right.
there's a lot of demand for
Right.
construction materials. So here we have
Prices
kind
have
of
gone
a,
up significantly. Sorry.
Yeah.
Lumber prices
No,
have gone up significantly. Yeah, and
Yeah,
you know, we're a developer, builder, owner, operator, and you know, all of our hotels that we build in-house are wood frame construction. And when you're competing with multifamily housing, and there's a boom in multifamily housing, we're not seeing any impact, you know, positively to materials. It's going the other way. The cost keeps on increasing. So it's been tough.
yeah, that's
Mark,
what
you've
we've
been on the, go ahead, Mark. LeBlanc.
But
Go for it, Mark.
no, I was going to say on the construction cost side, we actually have a project that is actually, you know, starting to get going again in the Central Coast area. That because of what Ron just mentioned on the wood, the increase in wood, they've taken the time and the delay to go back and reevaluate it, going with steel over wood. And what they found is it's been pretty interesting. Even though there may be a cost increase, you know, in hard dollars on steel, there are some benefits as far as it's a long-term hold for this group. So insurance benefits, you know, things that
I was going to say insurance.
Yeah.
That will help your insurance costs.
There you go, Jackie. I laid that out for you perfectly. So perfect for that. But that and then just also too, when you go from wood to steel, obviously there's a little bit of a market by market analysis, but institutionally, when you start looking at exit values and things like that, steel is considered to be a little bit more you know, attractive from an institutional. And so you can make the argument that you might get some cap rate benefit if you can say that you're, you know, have a steel construction component as opposed to wood, and so that can affect it as well. But that's I think that's one way people are, you know, I think the more sophisticated developers are taking a step back and saying, okay, what can we engineer? Going back to what you asked about the social distancing, you know, we operate a lot of hotels in the lifestyle space, and we're somewhat optimistic that at some point in the future, you know, things are going to be back to normal. So I think it's a little bit dangerous if you completely re-engineer a building and reduce capacities and so on and so forth. I mean, you know, we could be sitting here in 2 years saying, hey, we're kind of back to where we were based on, you know, a successful vaccination rollouts and, you know, numbers dropping and so on and so forth. So I think you have to be a little careful of, I think you want to be reactionary, but I don't think you want to overreact. I'd be curious to get Mark LeBlanc's, you know, opinion on that. So.
Yeah, I mean, I guess I'm really inclined to think that human nature will go back to being what it was pre-COVID. Now, I'm also the guy that said last year at this conference that we wouldn't even be talking COVID a year from now, so it shows what I know.
I actually think you said 6 weeks.
Did I go that long? Okay, so I did want to go backwards, if we could, for a second. I did have a question for Ellen and Susan. So when you're doing a BOV or an appraisal, what are the data points you're using today? I mean, are you going to 19 and taking a 20% discount? I mean, what data points do you have when a hotel's been closed? I mean, what are you doing?
Yeah, well, on the appraisal side, everything, we've had to kind of rejigger all our models, all our write-up, everything to use 2019 as the base and explain why. That 2020 is kind of viewed as a year to skip over. It's not a normal year. And people talk about performance in 2019, how the hotel performed in 2019, and also what the value was in 2019. So when we look at that, we apply what cap rates were at that point in time, and then we don't just say, okay, well, now let's apply a 20% discount. So your value is the 2019 value less 20%, but we do a full forecast and build it up and try and figure out crystal ball the operating expenses, which is a challenge. But basically, we try and get back to 2019 performance at some point out in the future. And for each kind of asset and market, it varies when you get back there in 22, 23, 24, 25, and some in 26, and then do a DCF and then look at what your discount is. And we, at the beginning of this, we had actually applied elevated discount rates because we felt that there was, the lack of capital and that there was going to be a hit on value. And now we've pretty much gone back to pre-COVID discount rates for the most part, because the market has rejuvenated itself. And because we see a light at the end of the tunnel, there's a lot more activity. There is some debt coming back in the market, and we're not seeing huge discounts on assets. I mean, there are discounts, to be sure, but nothing to the degree that we thought they were going to be, at least right now. So that's how we look at it. But 2019 is kind of critical. Alan, how about you? What are you looking at?
Yeah, so in the, so the middle part of COVID, you talk to buyers, and buyers were pricing deals at 2019 NOIs at 10 to 12 caps. Well, that pretty much worked into a discount pre-COVID to 40 to 60% on values. So obviously we didn't have a lot of sellers, and with banks deferring, you didn't have any foreclosures. There were a couple of transactions, one in San Francisco and one in West Hollywood, that traded at a 12 cap on 2019 net operating incomes. Towards the end of 2020, those cap rates came down to maybe 10. Now with the vaccinations, people are talking around 8 to 10. And just yesterday, I got a call from a buyer out of state saying they're pricing California assets now at 6 to 8 caps on 2019, which is pretty much, back to where we were at. Now, whether or not they close at those prices remains to be seen. But I think a lot of people that came to the market with hundreds of millions of distress funds are finding that those properties just don't exist. I think that they will now quickly change the name from distress, white it out, and change it to opportunistic. But the amount of distress that we were all anticipating has not come along, and that's really driven prices back up.
Yeah, but I would add to that, Alan. I mean, to rename it opportunistic, I don't know. I think these values are still sort of core pricing. There's a big disconnect between what you're paying for right now versus the operational value. You still have 3 years to make up what you're buying at now, and it's still a big disconnect. I think buyers still are expecting a 20 to 25% discount on assets that are out there, but we're just not seeing it. If anything, maybe it's a 5 to 10% discount. When COVID first happened, I think you had maybe there were some distressed sellers that sold or put their hotel out on the market, and you can see maybe a 20 to 25% discount. But I'm just not seeing that opportunity anymore.
I agree with Ronald on that. What we're seeing is the funds have raised so much capital, and they're getting so much pressure from their investors of saying, put it to work, that quite frankly, I'm seeing some assets I would say are selling at above market prices. I don't know if Suzanne agrees with that, but as Ronald said, we're not seeing the big discounts anymore, and the optimism that is in the marketplace for California hotels, it's almost as if COVID didn't happen. And
the other thing too that I would add is, and I wish Robert were on here, but your traditional lenders aren't at the table either. It's your debt funds that are there providing the financing, and that's still relatively expensive money. And until the banks can come back, the traditional banks can come back, you're not going to see pricing on the cost of the debt driven lower.
I'll add one thing to that too. Go ahead, Mark, and I'll go after you, Mark.
I don't know if this is good news or bad news, but I was on the phone yesterday with 2 different special servicers, and they're saying the wave is coming. They said it's that simple. They said between loan maturities coming and the fact that particularly on these big boxes, these people are going to throw the keys back at them, that the wave is coming. Now, we have a platform to do receivership work, so sometimes I feel like an undertaker during the plague. We will benefit from if that happens, but at the same time, it's not good for industry. But I think we're a long way from out of this, particularly with certain product type. And so we'll see.
Yeah.
Go ahead,
And
Mark.
I
think-
see.
Oh,
Oh, so
good.
sorry,
I
Mark.
was going to add, I think a lot of it too depends. One of the things that I've, really found over this last year, and I know we'll talk a little bit about it maybe as we get into the panel more, but this is really where you understand how your capitalization is currently set, because so much of what your future decisions are going to be are based on, your current equity, what their time frame is. Do they have fatigue from other investments? There's so many factors that become individual to each either ownership group or partnership or institutional capital that might be involved in the deal. And that's really what I've found. I've been surprised that there hasn't been more things transacting, although I know, and we've been involved with quite a bit of note. There's been a lot of note transactions, and Alan, you probably see quite a few, but there's been a lot of note transactions that actually haven't even really reached the brokerage network. And so that to me, I think you do count that in the distress category, because if a note's trading, that means the lender is concerned about, the health of an asset. But I also think that with the notes trading, it's actually given partnerships or owners a little bit of a lifeline, because the note trade acts as a bit of a reset to re-engage in conversation with ownership or with groups to see, hey, how committed are you to the asset? Do you want to keep committing capital to it? What's your strategy with the asset? So it's been interesting to watch how each individual group will look at things differently. And there's some, like you guys are describing, where people are just going to put their hands up and give the keys back. That's just the reality. They don't see, a time frame that they're comfortable with. And so I think that's gonna sort of come to light here, over the next 6 or 9 months.
We've started seeing some on our end where clients are taking over properties that are being foreclosed. Hope there's not a lot of that.
Yeah. I just want to add that there are some sales that evidence that there has been some discounting that's going on, and I think it's primarily in markets where you just can't see. There's no clarity on when the commercial and group demand's coming back, like the Sir Francis Drake sale, for example, which is reported at a 7.2 cap rate, but I understand the cap rate's actually lower, below 7, because they negotiated the buyers paying the transfer tax. Our transfer tax in San Francisco has increased now to 3%. And San Francisco is kind of known as a 5 cap rate market, even though some recent sales before COVID, we had such a, some of the hotels were selling at sub 5 cap rates, 3 to 4 cap rates even. But if you just assume a 5 cap rate was market, and then let's say it's sold at, say, a 6.8 or a 7 cap rate, that discount is about a 26%. And, to replace something like the Sir Francis Drake, you're talking $1 million a room, and somebody's buying at $378 a room. So, there's probably some of that going on, and it's going to be a long time before that San Francisco market is rejuvenated. It's really probably the worst hit, or one of the worst hit in the country. So there is some discount going on. Yeah.
Was there debt in place for that, assumable debt at all?
I had looked that up, and now I've forgotten what I concluded. But I don't know. I can check and let you know.
Let's switch gears just a tad to third-party management companies. And Mark LeBlanc, with you being dead in the middle of that area, what do you see in the effect of COVID on third-party management companies, and what should hotel owners expect from their third-party management company?
Yeah, I think one of the positives that have come out of this is our management teams are much more in tune to what the staff was doing, because they have been the staff in the last year. Many cases, you go in and see a manager working the front desk. So I think, that's a positive. But I think, and it's nothing new. I think one of your last panels was talking about this. I think the acceleration of technology and the use of it is something that's going to occur. Mobile check-in, touchless rooms, all that stuff that was in the works before, I think is going to get accelerated without a doubt. And I think, management companies, the ones that survive, and most will survive, I think, are going to learn a lot of lessons out of this and have a better product because of it.
Hey, Jackie, I'll add something. Jackie, let me jump in on that one as well.
Yes, please.
So we're smaller than Mark's company, obviously, but we're we're at about 30 hotels open, and with some in development and renovation behind it. So we have a pretty good understanding snapshot. We're a pure third-party platform. We've done that by design. And one of the things that we've learned over the last year dealing with this is everybody can get along great when things are going great and business is great. But this was the year that really, really tested, what that owner third party relationship is and what's behind it and the foundation of that. Because, we literally shut everything down, had to, lay off employees and take owners through forecastings and cash burns, and then went into PPP and assisted with securing PPP, and then now reforecasting where we get open. So all of those relationships really got, I think, put through the test. And what we found is that we were pleasantly surprised at how strong our relationships were, even though there is quite a bit of uncertainty and pain going forward. We felt like for the most part, we've really aligned with the owners and really, became an extension. The effort's been, a very collaborative effort to just move through and survive this thing. And so I think that's what we've taken away from COVID in a lot of ways. I think in some cases, once we hopefully get to the other side of this, in our case anyway, the owner management relationship is going to be stronger, and there's going to be things that we've all learned from this, things that maybe we can continue to implement to continue to drive profitability at the asset level. So, but that's the optics or the magnifying glass that was shined on this, is that relationship between owner and manager really had to be strong to navigate this. So.
Ron, one of the questions you had mentioned was the type of projects that you guys have actually looked at, that you've seen a number of projects come across your desk, but not all of them have you been interested in pursuing. What have you been interested in pursuing?
Well, we're primarily looking at both land and existing hotels where we can, in the sort of the select service branded space. And so we're looking at opportunities where we can build, and we're looking for opportunities where there's already existing asset. We actually looked at a deal where we thought, okay, hotel, great real estate. But after touring the hotel, we thought, wow, this would be a better multifamily play. And so we actually shifted gears and tried to bid as a multifamily play, because we thought that was the highest and best use for the asset. But, incredibly, there were other buyers that bid higher as a hotel play. And so, there's a lot of things that we're just scratching our head on in terms of, pricing and trying to get the returns that we need. So, there's still, like I said, there's a big disconnect in what we think is value and what things are really trading at. And so we're trying to be very selective as to what we look at. We're not going to go into all markets. We need to be very strategic about our growth. But long story short, to answer your question, we're looking for select service branded where we can build, or existing select service where we can acquire.
Very good. Well, this question's not for anyone in particular. I would like to get everyone's take on this. Hopefully we've hit the bottom, right? And we're just ready to start going up. What advice do you have for whether you're a hotel owner, an operator, a lender, or investor? What advice would you have for that person, either from being apprehensive of what to expect, or being excited of what to look forward to? Mark LeBlanc, if you'll start.
Yeah, think long term. COVID's going to be gone. I wasn't right on the 6 weeks, but it will be gone. The things that are going to be the headwinds going forward really going to be, in my opinion, particularly in California's government regulations. That's going to be a much bigger and longer problem than COVID, and much more costly. So if you have a long-term perspective on things, I think you're going to do just fine. If you're trying to make a deal and get out in 3 years. You might get lucky, might not.
Okay. Mark, Crisci?
I would, my advice would be for everybody you listed in that scenario, I would say be optimistic, but be realistic. And that's going to be very, very important. I know everyone's excited, as are we. We see bookings for end of spring and summer, showing some positive signs. But let's not forget, as an industry, 60% of our business is business travel. And everybody knows that we need the business traveler to get back out there and start traveling to some degree. And, I think everybody on this panel can agree, even with some of the occupancy coming back, the rates are still very, very difficult. It's very, very difficult to get rates back. So again, just be optimistic, but be realistic. And hopefully we'll all, ride the trend back to where we were, in 19 together.
Sure. Ron?
I think what we learned was, we were hearing sort of pre-COVID to get ready for a recession, and that save your capital to go on an acquisition spree. But what ended up happening was we were saving our capital and cash to really just survive. No one knew that this pandemic would be so crushing. But I would say going forward, just be well capitalized. You don't want to over leverage. And when there's good times, you got to save up for that rainy day, because you never know what's going to happen. So just, be prudent with how you capitalize your investment.
Okay. Lynn, do you want to comment on this one? I don't think we've.
Were you talking to me, Lynette?
Yes, Lynette.
Okay. Yeah, I think that what everybody said, think long term, consider how to raise your capital. And, if you're looking at development, which I do have people in California that are looking at development, to really look at the long term stay scenarios in their development piece and put a good team together. And the best is yet to come.
Jeanne?
Yeah, sure. I think my advice is just to continue to innovate. I think it's fun how the market has continued to reimagine what it really means to be a hotel, right? The hotel umbrella used to be small, and it continues to grow to include cuisine, lifestyle, media, sports, entertainment. There's so many things that our world encompasses and touches. I look at the ESPN broadcast center that's just opened up at the link on the Strip. And, that's just a really unique asset and a way to build excitement around a property and around what we do. So for us as designers, it's about being really flexible in how we approach a project. But that infinite combination of the role that a hotel can play in the market and in the lives of people is really exciting to me. So keep innovating.
All right. Alan?
Well, yeah, I think I agree with Ron. If you don't have a lot of leverage, then you're prepared for a down market, and you can weather the storm. But I think when you look to markets like Manhattan and Chicago, it sort of really hammers home how negatively impacted hotel owners are with union hotels, and how inflexible they are. We've got a number of clients that, despite the fact that they were forced to close down due to COVID, they still had to pay union labor, or even when they came back with restricted use and fewer employees, they were still burdened with fairly large payroll and benefits programs. So I think it's sort of highlighted during this downturn that you have to be a little bit careful if that hotel is unionized labor. And again, it goes to those larger business service hotels. And I think that people will be looking at those a little differently as we come out of this COVID pandemic. And again, it bodes well for the smaller owner-operator hotels. I think what we saw here is where most buyers and franchise companies had turned away from exterior corridor hotels, they actually have made a resurgence during COVID.
Okay. Suzanne?
Well, first, just to Alan's point, about union, the issues with union, we know of one hotel that we worked on in San Francisco where they furloughed a number of employees, but to actually get them off their payroll, where would have to permanently furlough them, they would have to pay about $110,000 per employee to pay a certain amount of wages and benefits because they're unionized. And it's like a huge sum, and they haven't paid that yet. So it's like, there's a lot of risks with unionized hotels. But just back to what Mark Crisci said, I think being optimistic and realistic, I would also suggest that people run a various sensitivity analyses, perhaps, in markets where there's not a lot of clarity, to see what your downside is. And again, best to not over leverage, because I think there are some markets where we could really see some disruption. I mean, the markets that have been the darling of the industry in recent years, which are the tech-driven markets, which are very, very dependent on tech commercial demand. We know these companies are saving, millions and millions of dollars by not having their employees travel as much. And so, everybody says, oh, commercial travel is going to come back. It's, everybody has to meet face to face eventually. People are going to realize that, which I agree to some degree. But if you've got a company that says, my God, I used to spend $100 million a year in travel, and now I can get away with spending $50 million in travel, that's got to impact. And you apply that to all the tech companies. There's got to be an impact. And if we don't have compression from the high-paying commercial traveler in certain markets, what's that going to do? Like, what's that going to do to the ADR? Like, to me, the biggest risk is the average rate recovery in a lot of these markets, because you just may not get that pricing power. And we could actually end up being oversupplied in certain markets, especially markets that don't have another demand segment. Like Silicon Valley is pretty, it's not the place that people flock to on a weekend for their leisure demand, unless you're a sports team, maybe. But so I just think that's a big risk, and people, as long as you're going with eyes wide open and run some analysis and don't over leverage, you should be okay.
All right, final question, and we always have this one. Why do business in California? And we'll start with you, Suzanne.
Well, it's a wonderful place to be and live. It's a center of innovation and just great, wonderful, sharp minds, and we all know incredible weather and beautiful scenery and places to explore. I mean, we're really our own country here, and it's just, our economy, the size of our economy. And I know we have our challenges, but there's I think we all realize it's a special place as well. So anybody investing in hotels, people want to come here and visit. So no matter what, for business or travel or group, and so long term, it's a great place to invest.
All right, Alan, what's your thoughts?
Well, I think from a hotel investment, we got huge barriers to entry in California. You're seeing that also, as Ron said, about construction costs. So when you're buying existing product, you're still quite substantially below replacement cost. As Suzanne said, the weather, and Jackie, pointing at you, at least we have the utilities at work.
There you go. But you don't have ice storms. No ice storms.
That's true. Okay. Invest in California.
Which we don't normally have ice storms either. Jeanne.
I have the ice storms. You're calling on me next. So I'm dialing in from Connecticut today. I've got piles of snow around me. So I'm obviously going to comment on the weather as number one, but the opportunities are endless in California. The economy is robust. Diversity is great. The natural landscape is incredible. It's always going to have a powerful draw and a place in my heart, and I know our firm's heart. We've been there since the 1940s.
Lynette.
Oh, I just love California. Family in California. I'm in California 4 or 5 times a year. There's just so much to do. I think I want to move to California. I think there's great opportunity there.
Great. Ron?
High taxes, high labor costs, high workers' comp costs. Oh, why do we want to do business in California? Weather is great. Diversity is amazing. Food culture, great public university system. So yeah, California is the best.
Mark Crisci.
Well, this was an easier question to answer a year ago.
Yeah.
Yeah, it's been a confusing year with our, I don't want to make this political, but our administrative decisions out here. But I will answer the question this way. I'm a believer that history is a great, determination of what happens in the future. And so I think that we'll get our mojo back as a state. And when we do have our mojo as a state, we're a juggernaut. But with that being said, I'm hopeful that at some point the state will make this a little bit more of a friendlier place to do business. That I think is a necessity. And regardless of what side of the aisle you're on, we're all in business. And I just think that there's some things. I mean, Suzanne, when you tell me it's $110,000 per employee to close, it just makes no sense to me. There's nothing you can tell me that makes sense in that scenario. So I'm hopeful that some of those things will maybe start to change a little bit to find some equal ground. And again, long term, it's how do you argue? How do you argue with California?
Mark LeBlanc.
Yeah, I think it's a math question. What everybody just said here, there were more positives than negatives as of today. And as long as there's more positives to be here than negatives, I think people are still going to want to come here and do business. And that's the way it is today. And hopefully that doesn't change.
All right. I see Craig Sullivan is with us.
I am, and thank you all very much. What a great panel. Jackie, you're always my closer, and I really appreciate this. We've got 3 great management companies here, one of our trade associations, a stellar architectural firm, the most prolific hotel broker in the state of California. Suzanne Mellen's got some of the best information you can get in California. I thank you all, and this panel has just been terrific, and I thank you, our audience, for joining us. We've shortened the program, obviously. I didn't want to keep you here all day, but we're going to keep the gate open till about 2 o'clock. Please go in and visit the exhibitors. You're going to find great information. Did you know the documentary transfer tax went up by $5 per thousand in Santa Monica? Going to Mark Crisci's Doing the Right Things. Did you know it went up by $9 per thousand up in the Bay Area? Okay, you're going to get great information here. You got 8 brands here. You've got various other third-party professionals, including our good friends at Gallagher back there. We are going to keep this platform open for 30 days. So you can come back, watch the panels, go into the guest rooms, download information. And as it stands right now, we are going to have CLIC 5 live and in person at the crown jewel of the Anaheim Resort area, the JW Marriott, on October 5th. I want to thank those of you, especially Stephanie Zapalak. She's been the first one to register for this conference for 4 out of the 5 years, and she's already registered for CLIC 5. So we've got a few of you that decided to pay for that, and I truly appreciate that. Mitch Miller was another one. So I thank you all. Go network. You might want to click on the late checkout button. That way you can hang here a little longer and talk to everybody. I'll be in my room. I'm always in a room. I don't think I've ever left the house in a year, but I'm still in a room. So thank you all, and hopefully I get to see all of you before the end of summer. Planning committee meeting, and we will jump on this for CLIC 5 live and in person, again, at the crown jewel of the Anaheim Resort area, the JW Marriott. Thank you.